$10,000 into the top 500 companies in the US stock market. Do it twice, using two different ticker symbols that hold the exact same stocks. 30 years later, one account has reached its full potential, while the other trails behind, missing out on thousands in compound gains. Those two tickers are Vanguard's ETF, VOO, and Fidelity's mutual fund, FXAIX. They are the two heavyweights of passive index investing. Both funds track the S&P 500. They buy the exact same companies in the exact same proportions, delivering nearly identical pre-tax returns. For a lot of investors, this makes them look like interchangeable commodities. Pick either one and you get the same result. But under the hood, these funds operate on entirely different legal structures. Buying the wrong ticker for your specific account type is a structural mistake, one that quietly drains your wealth over decades. Vanguard's VOO charges a low 0.03, but Fidelity's FXAIX charges exactly half that, just 0.015%. Over a 30-year timeline, these pennies compound. The lower fee fund retains more capital, reinvesting and pulling away. The entry requirements look different too. To buy VOO, you generally have to purchase a full share, which often costs hundreds of dollars. FXAIX requires zero minimum investment, letting you buy exact fractional dollar amounts and easily automate your deposits. Based on surface-level costs and accessibility for beginners, Fidelity's mutual fund appears to be the clear mathematical winner. But there is a mechanical flaw built into mutual funds that threatens that lead. It's called a capital gains distribution. When investors sell FXAIX, the fund needs cash. The manager is legally forced to sell underlying stocks, triggering a taxable capital gain. The IRS distributes that tax bill to every single shareholder. Even if you didn't sell, you owe taxes. Long-term holders are effectively punished for the actions of short-term traders. Paying those unexpected tax bills strips cash out of your portfolio, creating an invisible drag that stunts your compound growth. VOO is an exchange-traded fund, and ETFs operate on an entirely different set of plumbing behind the scenes. ETFs utilize in-kind redemption. Instead of selling stocks to raise cash, large institutional investors swap baskets of underlying stocks for ETF shares, trading them directly. Because managers never sell securities for cash, they don't realize internal capital gains. This structural advantage acts as a shield. It isolates your money from the tax liabilities of other investors, ensuring your growth remains fully intact regardless of who else cashes out. There is no absolute best ticker. You simply have to match the ticker to the correct investment account. If you are investing inside a tax-sheltered retirement account, like a 401k or a Roth IRA, you don't pay taxes on capital gains distributions anyway. In this scenario, the ETF's inherent tax efficiency becomes redundant. Since tax drag is no longer a factor, the priority shifts to keeping fees as low as possible. For retirement accounts, FXAIX is the undisputed winner due to its 0.015% expense ratio and automated fractional investing. But if you are using a standard taxable brokerage account, you are exposed to the IRS. Here, avoiding mutual fund tax distributions saves you far more money than you'd gain from a slightly lower fee. VO wins. The legal structure of your account dictates the legal structure of the asset you choose. There is one final detail: portability. Since VO is an ETF, it trades like a stock. You can transfer your shares to almost any competing brokerage for free if you ever decide to move your accounts. FXAIX is a proprietary Fidelity mutual fund. While some outside brokers will let you hold it, trying to purchase additional shares on a rival platform can hit you with transaction fees of up to $100. Financial freedom relies on these precise structural decisions. Verify that your assets match your account types today.